good evening. Welcome to the Nigerian Pride. Today, the 24th of August 2022. A lot has happened between last week and this week. Cost of living keeps going up. But even as that is happening, many have started talking about the cost of rent, the cost of even having your own house, the cost of even getting on the housing ladder. And that's why today I was surprised in the morning when BBC Radio Scotland morning show actually discussed the topic we're looking at today. But that won't stop us from having a discussion about it. And with me, I've got my guest who is ready to go and ready for all the questions we have today. And I'll just call him on so that we can kick off straight away. Hello, guest.
Hello, thanks for having me. My name is Stephen Babatunde. I work as specialist mortgage and protection broker. So, yeah, nice to have you.
Good. Thank you for coming and thanks for accepting our invitation. Well, I think we should just go into it straight. Cost of living is gone through the roof. It's not that it's going through the roof. It's gone through the roof already. And we have people who are homeowners. We have those who are aspiring to become homeowners. And when we start looking at this, we start talking about, okay, mortgage, which we know, it's part of the areas you are in. And the first question really is, what are the key things we have to be paying attention to during this difficult economic times that we found ourselves in, especially if you're a first-time buyer?
Okay. Well, so when it comes, obviously, mortgage, as you say, it's basically, it's a big investment. That's what you are trying to do. What are the things you need to be paying attention to? Regardless of, regardless of what the economy is saying, you always have to be know how to manage your finances in the first instance, regardless of what the economy is saying, what the cost of living is saying, and also if you're going to be an homeowner or not. So the whole conversation starts from you managing what comes in and what goes out. So that is one thing, which is a big one. That is more like the bedrock of any financial planning. You want to be able to be accountable to yourself and your family. If I earn £1,000 a month, out of that, what goes out in what we call basic expenses, well, your committed expenses and the other form of expenses. So you want to be clear as to what you are spending on a regular basis, and you want to be clear as to what's coming in. The moment you are hand to mouth, that's becoming an issue. So regardless of the economy, to put it straight out there, you have to do that on a regular basis, and that's what sets you and give you the bedrock to move on. So as per being a first-time buyer, that was your question, right? So that's one thing that everybody must do, the first part I mentioned. And also doing so, you want to have a very clear eye on your credit, basically how much you are borrowing, how much debt you have in total. So this is all the big part of the financial planning. I cannot overemphasize that, the importance of that, before you talk about even buying a shoe or treating yourself to whatever it is. You want to make sure you are crystal clear on that. Just to put that out there though, first time buyer, you need to make sure you have a regular income. That's a bottom line. So that's your source of income, because at the end of the day, we talk about mortgage, but this is a loan taken out to buy a property. So the property you are buying is a collateral, if you like, for the loan you are taking out. So that is what the mortgage is all about. You are borrowing money. You could have borrowed, or you could choose to borrow money for anything else, buy a car or take a loan. It's still based on the same principle of, right, before I can give you 100 grand, what are you earning per month and what is going out? So that's one thing. You have to have an employment, and then you want to make sure that wherever you are living right now, having your name on the electoral roll goes a long way for everybody. And also the third part is obviously managing that income. Source of income, make sure you are registered on electoral roll, and just watch your spending, really.
That's really key. Watch your spending, be on the electoral roll, have a regular income. Now, what you said at the beginning is what I will go back to, because you said you need to be able to manage your finances properly, because you use that adjective, properly. Now, the question is how? And why I said how is that, okay, let's say we have someone, he earns maybe around 3-5 a month, right? He's got his credit cards, he's got the regular payments that goes out every month, but at the end of the day, he still has about between 800 to 1,000 pounds left to do whatever he likes with. So, does it mean that you need to be sure? Is it about showing that you can, you have the savings to afford it, or is it just showing that discipline of financial management?
Okay. So I will break this into two parts. Okay. So the one part that is just a general umbrella, it's using your example for taking your illustration on, you showing that the way you show that you are managing your expenses is you are living within your means. Okay. So you take home £3,500 a month. What do you do with that money? That's basically, and the easiest way to actually face your own reality is to have these things written down. Where is your money going every month? And you do this month on month. I'm taking myself as an example here. I have a spreadsheet. I know what should be going out every month, and I know what I should expect to make sure I fulfill my financial commitment on a regular basis. So it's not about you showing, of course, when it goes into anything you want to borrow, any money to buy a house or to buy a car, whoever is going to borrow you that money, want to make sure that you can repay that money. You can repay it. So you want to show us not just what you are earning right now. I want to see how have you been managing your expenses in the last 6 years, your income, your borrowing. Are you always spending? There are factors. What I'm saying here, just to be totally clear from the disclosure side of things, I'm not giving any specific advice on any specific issues. So this is me just doing an umbrella advice. Of course, your situation, it might not meet your situation right now, but this is a generic, you see. So you want to make sure that I think an average lender want to see how you've managed how you've been handling money or borrowing all through your life, basically. Because if you've ever had a CCJ, which is CCJ or any trust and any money issues that you've ever had in the past, you will still need to declare that going forward when you are borrowing. So it might not have an effect on what you are doing right now, but it's something on your file. So general rule of thumb, you want to live within your means, and we use different yardsticks. Some people will tell you 80-20 rule or 70-30. Basically, from everything you earn on a month, no more than 70 should be going towards your expenses and whatever. So you should have a 30% to maybe save 10% out of the remaining 30, 10 to do whatever, anything else, and 10 to treat yourself, and thereafter. So if you are eating into that 80-20 or 80-30, 80-20 or 70-30 rule, right, you want to start tightening up and asking yourself what's happening. So that's how we look at how you can afford what you want to borrow. What is coming in, what is going out, what is left.
What is coming in, what's going out, what is left. Okay, let's focus on that aspect of new application now, because this is a part of the questions I've been asked. Okay, I know you've touched on some of the things to start doing in anticipation to managing your finances, looking at your borrowing, You're borrowing your loans and everything like that. Being on the electoral register, having a regular income. Apart from those, what are the other things we need to pay attention to?
Well, so we are talking about criteria, and again, using an umbrella, for example, of course, with any borrowing, with any financial commitment, it is a good advice, and it is the right way to do it, in my opinion, to make sure that you don't take any loan to retirement. So what I mean by that is, if you are 55 years old right now, you're looking for a mortgage to buy your own first home, I think my advice would be around you making sure, can you pay this off before you are age 68, which is the official state retirement age, for example. So having all that we are talking about criteria, and again, with that many lenders out there with different criteria from the financial side of things, I will always be looking at, of course, again, you take it client by client, customer by customer, but the good advice will always be for a new applicant, can you pay this off before you retire? Because your retirement money is to maintain your daily living. So that will always be the focus for a start. So that's talking about the age, your age in relation to the loan you are looking to take out. And also for new people, for first-time buyers, we call them, looking to step on the property ladder for the first time, you really want to get your advice from the beginning. What I see a lot of people do, a lot of clients do, is they start saving up, and maybe they've been saving for 2 years, and they have some money sitting there, and they now think, right, I can now go and get a mortgage to get a property. But how have you been managing your credit? And you won't be surprised by this. I hope you won't be, but these things happen, that you are spending your credit card. Yeah, you are basically maxing out your credit card, but you are saving. You have savings, but you're maxing out your credit card months and months. How does that work? Because what the lender needs to see is how you are managing all these credit card, loan, and other things. So those are the ways to look at it, really.
Okay. That's very, very interesting, because that point of the age, the retirement age never occurred to me before. But now that you mention it, that's something people should look at. Okay. We've looked at it from an individual perspective so far. Let's say we are like a club or a society, and we want to, take advantage of others, buy to let things. What should we be paying attention to?
Well, that's obviously moving away from an individual now to business, if you like. If you are looking to come together as a club, it doesn't necessarily need to be a club. Okay. It could just be a group of friends, want to start. Obviously, you go through when you come together like that in the form of a group of friends, you want to be operating under an umbrella. So we can have you want to operate under an umbrella, be it a limited company. So you want to start from, of course, you have to have this discussion with an accountant and with the right people before you actually arrive at one of the way we want to invest is in property. So you really need to do some work on your coming together. What does that look like? Are we going to be operating as partnership? Is it going to be, what are we in the first instance? So once you sort that out, unfortunately, I can't advise you on that one. But now let's come to you moving on as a limited company. You want to be operating, doing a buy-to-let. So the criteria, again, for that is different. But everybody involved within that limited company, we're going to have to try to assess them as an individual before we assess them as a business, because these are the directors. So who are you? What are you? What do you do? And all that round of discussion. But an individual can also have a buy to let, just to mention, to make sure we are clear about that. So as an individual, you have your residential property, or you do not, you can still have a buy to let. So it's not necessarily to do with groups or limited company. So,
all right, I see. So does that mean then that with the checks you talked about there, will it only be limited to the directors, or will it be every member of the group?
So let's say you have 4 people named within this business.
Okay.
So, and the 4 of you, your name will be on every business. Of course, this is the company, but these are the directors. Of course, we're going to be looking at everyone involved in the business.
Okay.
As if you are registering your company today, you have to list everyone involved in that business. And if you are buying a property in your business name, again, you have to spell out who are the people managing the affairs of this business.
Okay, interesting. So let's now go back to that individual buy to let. What's the catch? Because I know many people talk about, in fact, I have friends who are still renting, but they've got like 2-3 buy to let, and I'm like, what's the catch in it? I mean, what's the catch? That's what I was saying.
Well, so in the individual buy to let, you mean individual? Well, the catch is obviously it's an investment, right? So it's bringing in money to you.
Sure.
And property is one of the ways, in the UK, for example, all things being equal, property is one of your good investment. Of course, not in the short term, but over a long term period, provided you can manage it properly. It's bringing in. You have a buy to let. What you are basically doing is you have a business that rent out. You have your house or your flat is a business, and your customers are your tenant. So, and they pay for that service. And of course, just put this out there as an example to make it to take it home. With buy to let, if with buy to let, your deposit is higher, so you are required minimum. Some lenders take 20%, but let's say 25%. If you are borrowing 100,000, for example, no, the property is valued at 100,000, and that's what you are buying it. That's the price you are going to buy that property for. So you require the first 25, and then do the necessary assessment. Then obviously, most people do interest only on buy to let, which is, I don't want to confuse it too much. So it's basically it's a business. So it's bringing in. You might be paying on a property of 100,000, for example. Let's say somewhere around here. Not sure what the rent is like, but let's assume 2-bedroom flat. You are renting out, maybe it's 700 or 800 pounds a month, and what you are paying as the interest. Remember, if you do an interest only buy to let, for example, what you are doing is that 75,000 you are borrowing over 25 years will still remain 75,000 in 25 years from now. But the interest, you are paying that interest of month by month, which means you are reducing. Which means you are just servicing the interest. What you pay every month, instead of if that was to be a residential or capital repayment, you might be paying 500. Maybe you end up paying 200 because you're just servicing the interest. So it's just a business. Put it that way. It's a business that bring in. I don't think people move house every week or every month. No, so I think for the next 6 months, or depends on what contract you have, it's going to be regular. So that's the catch. If you ask for one, I'm not sure if it's a catch, but that is what it is.
Yeah, I'm just using the salesman word there to say what's the catch. But you delved into something really good there about this having to just paying the interest of the mortgage rather than paying the main. What's the real difference in that part? I don't know if you get what I mean.
Yeah, I'm with you. So capital repayment is basically I'm paying a portion of that 75,000 as well as the interest. So let's put it this way to simplify matter. So borrow me 75,000 over 20. I need the loan of 75,000, and I'm going to pay this off in 25 years, which means 25 years from now, I've paid everything, both the interest and the actual money.
Right.
So I've paid that all off. That is the capital repayment. Then interest only, I'm only paying the interest on that 75,000. So in 25 years, the 75,000 will still be there. I still need to repay that, but nothing else, because every money you borrow, you pay a percentage of interest on everything. But you that's what you've been doing in the last 25 years. But now, again, depends on how you look at it. All things being equal, with property doing well, the property that is valued at 70, or you bought at 75,000 today, well, won't be, hopefully, if you maintain it, obviously, it won't be 75,000 in 25 years to come.
Yeah. Okay. Wow, that's eye-opening. That's really, really eye-opening.
And a lot of information.
Yeah, if you're just joining us, you're true to the Nigerian Pride today. And today we have Stephen Babatunde with us. He's bespoke. I want to say that word. I've been looking for him. He didn't say it when he was introducing himself, but I just want to put it there. But he's an expert in when we're talking about mortgage, when we're talking about cover protection. Let me use the expert word, protection. So, and that we've been asking him questions now. I mean, we've dealt with the mortgage part so far, and I think where I want to take him to next will be the part where we then move into the remortgaging. So, one question I want to ask is this. At the moment, well, not even at the moment, between January and now, the inflation rate has gone busted, which has affected the interest rate from the Bank of England. Now, normally, if I take a loan from a bank, maybe I take a 25,000 loan, they will have, before I signed the contract to say yes, I said, they will have said, okay, this is the amount you'll be paying every month. That amount will remain constant for the next 5 years or 6 years that you're paying this off. But when it comes to mortgage, it's not a fixed price. Why? Why?
Well, you have with mortgages, I mean, you have different products. So you have different, you mentioned about taking a loan, and this is what you pay over 5 years. You can have that with a mortgage as well. Oh,
really? So for the whole 25 years?
No, it won't be for
it is possible for the whole 25 years. Everybody, let's go.
But why would you? Why would you though? So why would you? Well, of course, I mean, if it's there, so probably some people might take it. I think you have up to 10 years now.
10 years now, yeah, I've seen that.
So it's all about checks and balances, even if it's there, would you take it? So and again, that's just what the business is. This is a big, huge capital investment, you see. I want to make sure I'm making, if I lock myself into, so if I say to you today, this is an example, going by your question, if you are taking out a mortgage, so you mentioned remortgage, and we're still talking about mortgage and remortgage. Remortgage is just you. If you are buying up your property for the first time, so that's you getting a mortgage. After the 2 years or 5 years or 10 years, if you're looking for another deal, then you are remortgaging. So it's still all in the same loop. So if I say to you, this is an example, if you take a 2 years deal right now, you'll be paying 3.4% interest. If you take 5 years deal, so let me put it in money, okay? So 2 years fix, you'll be paying 600 for the next 2 years.
Okay.
If you take 5 years fix, you're paying 610 pound. And if you take 10 years, you're paying 650 pound.
Okay.
And if you're gonna take 25 years fix, just using, we don't have that right now, you'll be paying 750 pound a month. The option is not there right now, so we can't really talk about it. But that's how the parameters are set. And at the same time, it's good to mention that you are not just stuck with the fix. You have the variable. You have different. You have the cap. You have capped and collar. You have tracker mortgage, and you have different. About five different sort of like deal you could select. So, and I know most people do probably fixed rate. That's why you are talking about it. But you don't know that you are buying your first property, 2-bedroom house. Your family might grow tomorrow and you might choose to move. Why do you want to lock yourself into a 10 years fix? I don't know what your situation. You might be in that place.
You just nailed it there for us. Why will you want to lock yourself? Because and you know, you don't blame people from our community. When we look back at home, our maybe those of us who their grandparents were business people, how they borrowed money and they will be looking for, no, this is the amount I want to be paying every month, and the bank manager will look at and they do it, and they know that whatever business I do, come, this is how much I know I'm paying every month. If I now have more than that, I can go to the bank manager and say, okay, see, I've got this 50,000. I know I owe you 1 million, but I've got 50,000. I want to just pay off this one into it. I know, you know, but then where you just said it that, you know, yes, you may say you are going for 2 years fixed price for that 2 years, or you go for 5 years and 10 years that we have now. But what you've just said is that, oh, what if the family grows and you want to move? That means if you've not spent that fixed period, doesn't mean we can't move them, we can't remortgage.
Well, let me quickly, that was a good example, because this is why there is no one size fit all, you know, and this is, you know, when you see my post and whatnot, I always put personal touch guaranteed.
Yeah.
Because this is where we get to sit down. So, right, tell me what's happening. What's your plan? Now, you know, you are looking to, okay, why do you need the mortgage? Well, it sounds like a rhetoric question, right? Why do you need the mortgage? So what's the plan? You consider what are your expectations in terms of job, in terms of family? You know, are you with family right now? Are you single? So we discuss your option. Again, you drive the conversation as a customer. I guide you to understand, to put them into perspective and deliver your result. So that is what a good advice is all about. Getting out, letting the client tell you what is it they are looking for and why. Then you give them the guided and compliance advice. So now, going back to the why you have to look at the family happening and everything else growing, this is all, that's how it should be, and that's how you should roll every single time with any customer. Your needs should be a priority number one. Not what I think, but you telling me what you are looking for, and sit together to go through your options and arrive at what we think is best. Is it 2 years? Do you actually need to be on a fix? Can you just do variable and just leave it to, you know? And you are mentioning, you ask a question, what if within that 2 years or that 5 years or that 10 years, you need to move? You don't need to worry about moving at any point in time if you are not on any deals, if you are on standard variable rate, which means if the interest rate goes up, what you pay goes up. If it goes down, what you pay goes down. You can move at any point in time because you are not taking, you are taking all the risks, if you like. You are taking all the risks. So when you take any other deals, be it fixed rate, be it capped and collar, be it tracker, you are taking the risk to say, right, fixed, for example, I don't care if it goes down or goes up, I want to remain £600 for 2 years or whatnot. So in that event, if you do choose to move, a lot of lenders offers as an added benefit what is called portability, which means provided your new property meet the criteria, you can move the deal you have into the next. But failing that, when you take out any of this deal, fixed rate for example, you will always find a section in your illustration that tells you if you're going to break this contract, you will have to pay X amount of money. So again, to try help the customer is to give you the portability instead of breaking it. Why not talk to us and let's see if we can actually move you to the new property without you paying that penalty. So all the options are there.
Oh, yeah. Right. You know, this is why it's good to talk to those experts when it comes to this. You know, sometimes when I discuss with my colleagues, my friends, I'll say, if we had known some things we knew when we came into this country 10 years ago, 12 years ago, 30 years, we will have bought a lot of property here, because you'll have understood so much how it works. And that's why they say, information is powerful. And from everything you said there, I think that also the displays and shows us why you always say bespoke. Because I use that word a lot for my students in class. When I tell them bespoke, one of them was asking me, what does it mean? And I said, bespoke means when something is particularly for a particular person, for you. It's not about that person, it's for you. Yeah. So let's move on into the mortgage part. What does it mean? Let's start with that. What does it mean?
Mortgage or remortgage?
The mortgage now.
Remortgage.
Yeah.
All right. Okay. So a remortgage is, if you tell me you want to remortgage, what you are telling me before I ask any further is, you have a property already. So you can't remortgage if you've never owned a property, if you've never had one. So right. I bought my house 2 years ago, for example, and I'm coming to the end of my 2 years fixed deal. Okay, that's
a cue for all of you listening out there already. Go on.
If you are coming to the end of your deal, whatever that deal is, tracker, whatever it is you have. So once you start sourcing for another deal, what you are looking to do at that point is you are remortgaging. So lender A, you 2 years ago you came to me, I loaned you that 75,000. Now now you are looking for another deal, and then it could be that deal you might choose to stay with the same lender or shop to see if there is something better, which you should always do. Right. You want to keep as much money as possible back in your own pocket. So if now lender A is now your preferred option, they will now need to pay off lender A and take that property or that asset becomes theirs. So that's what you are basically doing. You are remortgaging. If you have a property already, you're looking for a new deal, what you are doing at that point is you're remortgaging. It's as simple as that. We use mortgage for first-time buyers, mortgage. Everything is still mortgage. Yeah. So you buy it, you're buying it again. So
okay.
Yeah.
So let's go with the time we are in. This present economic climate we have in the UK. For homeowners, those who have mortgages already, is it a good time for them to remortgage?
$1 million question. And
yes, because I've had the day we started throwing out your flyers, questions have been flying in.
Yeah. I mean, based on whatever if you're on a deal right now, if your deal is coming to an end, there is no doubt it's either you go on the variable or you look for another deal. So you don't really have the choice. Sometimes there is always an option. There is always a choice. If you are coming to the end of, say you're on a deal that is 3% interest rate. So you're paying £600 right now, 3% interest rate. And you're going to come to the end of that deal and you will automatically move on to the lender standard variable rate, which will be 5.4, for example. So your £600 is going to become £680 or £800. Yeah, £800. Just being out, £800 a month. Why would you not want to see what is? Can you save money? Can you not pay that? Is there a way is there another deal that can help you not to pay £800? You would rather not pay that if you can. So this is why you have to look. So again, is there a right time if you're on a standard variable? I think, let me put it this way. You just check what is out there, and a good broker like myself, we obviously, what is it you are paying right now? Can I do better? And you remember, it's not just about moving you on to the next mortgage. I need to make sure I work to your benefit. You are my priority. I need to make sure I give you as part of treating customer fair by the FCA, as part of the right outcome for my client, I need to make sure that the services I'm providing and the advice I'm giving is actually benefiting you, is working in your favor rather than against you. You can't be paying, if your interest rate, if you move on to standard variable and you'll be paying 800, for example, I can't come back to you and say, I think you should move to £810 deal per month. But it's all going to be on individual. Your deal is coming to an end. You have to look what is out there, because if you do not, you're going to move on to standard variable. A client came to me 2 weeks ago. He just received a letter, amongst many others, to say from 575 is going to move on to standard variable rate, which is now £810. And the light bulb moment, like, no, why? I'm not going to. He came to me and we were able to sort something out cheaper than the 800. So you have to look if your deal is coming to an end. If you are within 6 months to the end of your current deal, if you have one in place, this is the time for you to get your foot out, to get yourself out, speak to the right broker, see what deal is available to you. Don't wait till you start receiving the letter or your broker start calling you. I work with my client from the 6 months before. We start the conversation at that point, see what the market is saying, and if you can do better. And a lot of my clients are benefiting right now, because since between January and between December and now, the interest rate has gone up 1.25, if I'm correct. But you can imagine those that were able to lock something in back in February, back in March, April. So yeah, that's how it works.
Oh wow, that's interesting. I think you've answered the questions some people have been bugging me about, and I've been looking at my phone also to see messages coming in. So I'm just thinking about everything you've said there, because I don't know if there is any organization out there doing all this research to see what happened between 2019 and this time, because a lot of the members of the African and Caribbean community became homeowners between that time. And how people will say, how did you know? Because there's a database where you see the changes. It may not show you the people, but it should show you the numbers and show you at least a bit of things that will make you make sense of it, that okay. And even when you look around your circle, you see people who have now moved into their own houses and started, okay. So, and it makes sense when, I receive questions from these people who might know moved into their houses maybe tail end of 2019 or during the pandemic, and now they are now asking this question. From what you've said there, it's throwing it out there.
Yeah.
Now, another question I have is that, do they need to start consolidating their debts? Is that important for remortgaging, or is it just one of those things?
Well, just to pick up on the, people moving, I'm not taking the glory, because it's not just me that is doing mortgage advice, but I'm proud of, this is one of the reasons I move into this industry, to be able to help as many people, not just within all cut across, 80% of my client base are, everyday, Scottish, so I'm glad that statistics. I'm happy to hear that, and this is why I'm here, to be able to help as many people as possible, and long may that continue. So debt consolidation, again, this is totally, again, another, you don't know what you do. I'm just going to explain what that is. So you have some loan, or it could be bank loan, it could be car finance, it could be credit card, that you want to take some money out of your property, if you have enough there, if you can take it out to pay off that. So that's what you are doing from the mortgage side of things. So example, let's stay with our 100,000, for example. Let's say this is a residential property and you have 25% equity in that property, which means out of the 100,000, you have 25,000 is yours. If you sell that property today, you will take out that 25,000 will be your home money, and the rest you need to pay the bank, or your lender is 75,000. Let's say you have loans that you want to pay off, you want to pay that loan off, you can choose when you are when you are remortgaging, you can choose to add. You necessarily do not need to wait till you need to remortgage sometimes to do these things. You can approach your lender, or you can approach a broker to give you what options are out there. But what you should bear in mind when you are consolidating, as you said, I have 5,000 across my credit card and whatnot, and I would rather just let that money stay, put that money, take money out from my property. Basically, you are borrowing that 5,000, but that 5,000 is from your 75,000 you have left. You are now increasing that to 80,000. So you are losing your 5,000 equity in that property. So that's basically what you are doing. But you need to remember, as part of the due diligence that the client need to understand, that loan with whatever lender, that 5,000 loan that you're meant to pay over 5 years, the interest, you're going to pay that off quickly, and the interest rate on that might not be as high. But if you now taking that loan and adding that loan to your mortgage of 25 years, you're going to be paying over a longer period. You'll be paying more interest on that loan. So you are stretching a 5 years loan. Your 5 years loan is becoming 25 years loan. So, and remember, the longer it takes you to pay, the higher the risks. So if you were to be paying 3.5 for 5 years, it might be 4.4 and plus over a longer period. You need to understand that. You don't need to consolidate, but speak to the right financial advisor, speak to the right mortgage broker to give you options before you conclude on
Any of those.
debt consolidation.
Good. Okay, I'm looking at our time. I'm looking at the number of questions we've got, and I'm just going to try to just match them around. So when we come to, when it's still talking about remortgaging now, how much equity do I need? I'm just personalizing it now. That okay, how much equity do I need in my property if I'm thinking of remortgaging?
Well, you don't need to have, as long as you don't need to have any much. To remortgage, you need, I think the minimum with a lot of lenders, you have to, so when you, right now, let's say you have 5% deposit available with some lenders still, which means you have to bring me 5,000 if you are borrowing 100,000, yeah? When you are no longer a first-time buyer, and you are now doing remortgaging, you pay, a lot of lenders will say minimum of 10% deposit. Yeah, you can't borrow more than 90%.
Okay.
So when you are talking about equity, though, you don't really need to have a certain equity. So if I was equity and remortgaging, it's your equity is the money you have in that property. So it's your out. If you sell that property today, what you take out is your equity, basically. So, but when you are remortgaging, it doesn't really have a part to play as such, because in 2 years from now, maybe what would have been your equity in that property, maybe, it could be 10,000. It might be 10%. It might not be 10%. But when you are remortgaging, that doesn't really come into account as such to say, oh, do you have 10% equity in that property?
Okay.
If you are staying with the same lender, depends on the situation, you see.
Okay.
But it's not like you need to have a certain 10% minimum.
Okay.
With a lot of lenders, but all depends on the situation.
On the person.
Yeah.
Okay, so just to follow up with that, so when you are remortgaging, your credit history or your credit rating, does it come into play as well?
Every time you are borrowing some form of, taking some credit, that always goes back to that.
So how can that affect you when you're remortgaging then?
Well, you will know how good you've done.
You manage your finances. So we just go back to the basics again.
You go back to the basics. Obviously, it's not because you're on the property ladder, and this is so important. This is important because yes, now I've been able to get on the property ladder. I have my first mortgage. Then I can do as I want. No, you can't, because remember, there is always a disclosure. Your property will be repossessed if you do not keep up repayment.
Default. Yeah.
So not default. If you do not keep up
with the
repayment. So your property will be repossessed. You need to. Why do you want to do your credit? Bala 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 bala. It's financial management. You need to be on top of these things. Anytime you are looking to do anything, of course, there are occasions where you have some client can't really be remortgaged. They can't. I have clients. I've dealt with clients that can't really put them with another lender because their credit or their criteria. So they might be better to just switch what we call product transfer. Okay. Just stay with the same lender, but pick another deal with that lender because you're already with that lender. But that doesn't mean you should still be doing your credit.
Still go ahead. Yeah. But because they know you, that's knowing you.
They won't ask for it when you are remortgaging. It's like doing you are starting all over again. So we need to assess everything. I need to assess everything, get all your information.
Right.
But before I can advise you to stay with the same lender, I need to still do everything from scratch. And based on the information I have, I say, I'm sorry, we can't really. You must well stay where you are at the moment, and I still help you to make that happen.
Okay. Well, people, you've been listening to this wonderful expert. I mean, he has pieces everything for us. The next thing is to start booking appointment and saying, okay, I need this, I need that. But you're still tuned to the Nigerian Pride on Radio Jambo. If you don't know, now you know we are now available on DAB, on DAB. So you can be in your car and just look for Jambo Radio on DAB and you will listen to us live and direct. Also, you can still listen to us via the Facebook page or even via our website on www.jamboradioscotland.co.uk. There's this one, I'm trying to think of it, the one whereby, you own part of it, the organization owns part of it. What is that one called?
Shared equity.
Thank you. Shared equity, which we see with some of these housing associations sometimes. Are these better ways or not?
I mean, there is no better, there is... If your earnings and what you can afford is 900,000 and you can buy shares, you can buy 50% of it and that's available. Why not? You can. It's still a step in the right direction, of course. Two-bedroom property will cost you 100,000. Staying with the 100,000, I'm not saying that's the price, but staying with that 100,000, but based on your affordability, you can't afford 100%, and you have an housing association or saying, right, okay, well, I'm saying to you that all you can loan is 50,000. And you find an housing association or any, whatever it is, looking to say, yeah, you can buy half and pay rent on half. It's still a step in the right direction. Over time, you might be able to capital raise to maybe buy more shares. There will always be different arrangement. Depends on the organization to say, yeah, you can buy, 10% more, 15% more, and ultimately maybe you can buy it outright.
Okay.
So you always have all that option. But yes, I think something is better than nothing.
Okay. So like you added there, the person will send that question. Yes. Having something is better than nothing, so you can still go for that. If you need more, I will say, we are actually out of time here today. But the best way to do is that, if you need to contact Stephen Babatunde, you can always get in touch with him. Even if you Google his name, it will come out. Just make sure you put bespoke. Bespoke was, it will just like uniquely separate him in the search, and you'll be able to see him. Well, I must say thank you very much for coming on the show today. It's been very, very exciting and I would like to say eye-opening, intriguing, and it's stimulating because I know many people are now thinking a lot and things like that. One final question I'll be asking, which is more of a personal question.
All right.
How did you get into the mortgage industry? Because I don't want to start putting, because I always do my due diligence, background check on people, looking at the course you studied when you came to the UK and everything. How did you find yourself in this industry?
Well, I said it earlier. This is why when you mentioned this, when you stated the statistics about people, my personal experience from mortgage and taking out an insurance is a big drive for me to actually be able to. This is not a job. I say this all the time. Of course, I still make a living of it, but it's more than a job. It's like a lifestyle. It's like a calling for me to be able to help. I've heard so many things. I knew what I faced, what I passed through, having buying my first home. I knew what it was like, the kind of advice I received, trying to have my first insurance. So it's to simplify that process and to make it relatable. My experiences wasn't a case of I never felt I never felt I was priority to my advice to my advisors at the time.
Okay.
But I want to change that.
All right. Well, that's where we'll call it a day today. I think you've all enjoyed Stephen Babatunde with us today. Don't worry, we'll surely bring him back some other time. And just for other people, please, in case you've missed a greater part of this, we will rebroadcast this tomorrow by 5 p.m. Well, every Friday, the Nigerian Pride is rebroadcasted, so you can listen to this again. If you have any questions, you have our number, call on us. We'll link you up with Stephen Babatunde, and I'm sure he will do you a great work. I am Olushokumbi. We've come to the end of the Nigerian Pride today. Keep safe, be good, and I'll see you next week. Bye for now.